Yo, what's up guys? In this video, we're going to be analyzing Public Storage stock. It's actually one of my favorite REITs of all time, and that's because of the industry it's in and because of its unique financial conditions. So I've made a list here of all the self-storage REITs, and this one I've carefully selected, and that's actually why I own this stock. I forgot to mention that. I own this one here in my Robinhood portfolio. I own just over $3,000 worth of the stock, but I'm actually down 6.74%. So right now, in my opinion, I think it's a good time to buy. And also, I think this is a dividend investor's dream for reasons I'll show you later, but also because of their dividend yield of 4.66%, and they actually have to pay out this dividend by law because of the way they're taxed. They're actually a real estate investment trust or a REIT, and they're actually forced to pay out their dividends by law or else they pay taxes on it. So this dividend yield of 4.66%, I'm going to show you why they have so much room to raise it. And that's actually a lower yield than most other REITs, but I want to show you why this stock has actually appreciated so much, especially since 2019. It's one of the REITs that are actually above its 2019 level. But anyway, let me actually now show you their payout ratio. So most people will look at net income or EPS, which is what you would want to look at for most dividend stocks, but you never would look at that for a REIT, and I'll show you why. So look at the EPS right here. Look, it's only in that one quarter it was above $3 per share, and their dividend, of course, cost $3 per share every single quarter. And as you can see, if you looked at EPS, they would never be able to afford it. But that's why we actually want to go and look at the AFFO per share, or the free cash flow per share, which is this number right here. If you're wondering what app I'm using, it's called Webull, and I'll have an affiliate link in the description if you want to download it. But I actually want to show you why I love Public Storage's dividend history. So I think they're unique for not raising their dividend every single year. So if you notice that, look, for a long time they just kept their dividend at $2, then they rose it to $3, which is a crazy increase. But I like that they don't force themselves to have that higher payout ratio, because why do that? And I think almost all investors are pretty happy with the 4.66% return in cash every single year. And of course, if they wanted to, they could raise it to $4 and still easily afford that. Look, if you average out the 4 quarters, they make well above $4 in free cash flow or AFFO per share every single year. But let me now actually visualize the dividend payout ratio for you so I can show you how much room they actually can raise it. So here's the number they pay out the dividend from, and in the most recent quarter, it was $791 million. So we'll just take that number right there, 791 million, and their dividend cost 576. So that's why I'm saying they have so much room if they wanted to raise their dividend. So that's why they're not actually at the 90% payout ratio, because they're actually keeping some of their own money, retaining it and paying taxes on it. But because they're retaining so much of their own earnings, they don't have to dilute you as a shareholder to acquire new assets. They don't have to issue debt. And that's super important for a REIT. So actually, let me show you that. Their total common shares outstanding. If you look at almost any other REIT, the total common shares outstanding will be up like crazy year over year because they have to dilute you to acquire new assets. Well, not Public Storage. As you can see, you've literally only been diluted to 4% year over year, which is literally nothing. All right, so check out what this website says. We already disproved this, but it says they have a dividend payout ratio of 108%, which it says that they use this calculation based off earnings per share, which we already disproved, and you don't want to look at that for REITs. We want to look at the AFFO per share, which Public Storage for the past 12 months made $16.47. Now, remember, their dividend costs $3 of this every single quarter, so 3 times 4, it's 12. But anyway, the multiple on this is actually a 15.65. So you just take this and times it by 15.65, and that's what the share price is. So I actually think this is a very fair price to AFFO ratio of 15.65. That kind of be like a stock trading at a 15 PE ratio. But anyway, now I want to go over their company presentation and why this company is so great. So they actually have an A rating, a credit rating from Moody's and S&P Global, 51 years in operations, and $3.4 billion in net operating income in the whole year of 2023. And as you can see, this is where they're all over the place. And look at their beautiful storages. This is some of the company highlights, but I want to go through this together because I think this is so cool. So look at this. We can kind of see the core real estate average sector, and we can see how the self-storage industry is growing a lot faster, a lot higher compound annual growth rate than the normal REITs. So they grow at 2.9%. Public Storage is growing at 5.1%. Well, this is since 2004, so the numbers could be a little bit cherry-picked, But anyway, let me show you what makes them different. So all of their properties are all digital. So all you need is your phone to get into the facility. They have tons of good reviews, like a 4.6 star review, and normal is 3.7 stars. But yeah, like I said, they have digital property access for 100% of the properties. So that means for some properties, they don't even need a human working there. So this whole property doesn't even need a human. Of course, there's security risks. And check this out. They have what they call an irreplaceable portfolio here in California, where Southern California market compromises 19% of our same store net operating income. And all of these little orange dots here, those are all the public storage, self-storage properties, and the orange or the green ones are extra space storage, but they clearly are the market leader here in California, and that's why a large portion of their revenues comes literally just from California, which, if you don't know, getting anything done, getting any new properties or anything rebuilt, getting permits for anything in California is like impossible. It takes time, and that's why the property home values over there are way higher than everything else. So the amount of rent they're getting per square foot is crazy high. And here's kind of comparing the public storage to all the other companies, but it's saying that they have a same store NOI margin, net operating income margin of 79%, when all these other ones are way below that. So they have a huge lead on them. And they're saying that they have a higher margin than all their competitors because of their payroll cost savings, because they don't really need to have that many employees, and because everything is all digital, which is so cool that they have that. And here's a little information about the debt that they have. So they actually issued $9.1 billion of debt at a 3% blended rate. So if you think about the high interest rate environments right now, for the average person trying to get a loan, they'd probably qualify for like a 6% rate. But because they are an A-rated company, S&P and Moody's, they're easily able to get this 3% blended rate. And we can see how leveraged they are by looking at their net debt to preferred equity to EBITDA ratio. And it's actually at a 3.9x. If you're like, I've never heard of this ratio, it's because they actually have preferred shares and preferred stocks. So they include that because, that's actually what you want to look at. And we can see that that's in line with their long-term target of 4 to 5x. So, they're very safe right now. And here's a little bit about their financial outlook. So for 2024, the core FFO per share guidance, public storage has the highest guidance. They're supposed to grow 1.8% when all of these other ones are basically break even. And we could see how they did over in 2023. They actually grew 8.3% when Extra Space Storage and National Storage Affiliate shrunk. I actually own CubeSmart stock as well. I own just over $1,000 of CubeSmart. They also are in a very limited supply market in New York, about where over 10% of all of their properties are just in New York. And they have some very high quality properties there in New York. And they think they have a really attractive valuation with a strong geographic mix of the most A locations, like A rated. And we can see, at the time of this, which was 2/29, so in February, this was the multiple they were trading at. So they were actually trading at just over a 16 times price to AFFO, which they're still trading at that. They're trading at a 15.65. So they're actually trading at a little bit lower valuation. But at the time of this, we can see where they are in line with all of the other valuations. But yeah, guys, thank you guys so much for watching. If you leave a comment, I'll respond to every single one of them. And don't forget to drop a like on that video. It really would help me out a lot. Smash the like button. Hope you guys have a great rest of your day. My name's Nate the Robber. I'll catch you guys in the next one.